The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the August 1st edition of Digging into the BI, where the members from Maryland, D.C., and Virginia of the Better Investing community get together and look at the latest issue of the Better Investing magazine. Here are the four stocks we're going to be looking at tonight: Sonos, CarMax, United Rentals, and Monolithic Power Systems. So let's go to the next slide. And this is our standard disclaimer. We're doing these for educational purposes. We're not intending this as a thing to recommend or purchase a buy or sell of a particular stock. We in the Better Investing community always recommend that investors conduct their own research and review and analysis of a stock. Any securities discussed here may or may not be in someone's personal portfolio. If we do show a slide with some information on it, we're not necessarily endorsing or promoting that particular website. And we are recording this, so it will go up on our YouTube site sometime maybe later on tonight. Next slide. So for those people that don't know us, and if you're maybe online, this will be where you're hearing it, is who is Better Investing. And there are the links to be able to get to Better Investing. Those are hyperlinks down below. So if you're in this presentation, you'll be able to download stuff. But up at the top on each one is the link, the URL for Better Investing, and it's www.betterinvesting.org. And we're all volunteers, so none of us are in our financial services ourselves, but just to sort of let you know a little bit about BI. Next slide. So we are Better Investing. We believe in investment education involves learn by doing, and those two people, George Nicholson on the right and Thomas O'Hare on the left, were there at the present when we started things back in 1951. And that's basically the approach we have here, and we carry it forward. Next slide. So if you need to be able to find us on YouTube, there is our YouTube channel. You can find it much easier by just going into YouTube and then in the search window, type in Digging into the BI and you'll find it. And our goal is basically to see if we can get to 50 subscribers. We made a nice little run here recently, and we'd like to be able to continue that. So when you go there or share it with anyone else, please hit the subscribe button and like some of the videos. Next slide. So for those people that are new to the webinar, this slide will sort of take you through some of the navigation for it. Over on the right-hand side where the green arrows are, that's where you can grab it with your mouse and you can be able to move that from the left over to, or it's over on the right to your left, or up or down to get it out of the way. By default, you are muted. We will unmute during question time at the end. You can raise your hand at any time, particularly during the question time. And if you do have questions, go ahead and type them out in the question box. And it may be easier if you pull that out when you see the questions, where the blue box is, that will be the way for you to be able to pull out that to be able to write to it. And you can be able to send it to everybody or just to the presenters. Next slide. So to get some additional help, go to webinar. The first thing is that there's a quick 4-minute video on how to get started if you have trouble with it. If you need some help with that, follow the red arrow up to the top where you have sort of the globe. That will get you some of the help. If you're having trouble, and some folks have trouble with the audio settings, follow the purple arrow. You should be set if you're on your computer to computer audio. If you're on your phone, you can do it under the phone call. And then finally, down below where the green arrow is, that's to where the handouts are, and be able to make sure to download those. That will give you the slide deck for tonight, as well as the 4 completed SSGs that are going to be talked about tonight. Next slide. So to be able to help things easier, you can see under the first thing, if you want to zoom the size to be able to make it fit a little bit better, you can do that. It sometimes is easier to do that. I finally figured out how to be able to switch to the new screen design. So next month we'll have this where it fills out the screen a lot better and will make the font bigger. So that will be helpful. But in the meantime, if we go through the slides, and we do move through them pretty quickly, you can hit where the number 2 is and you can capture a screenshot of whatever's up there just to help remind yourself. So when we get to question time, you can look at it and see what's going on. So those are some things to sort of help with improving your viewing and being able to keep along with us as we're going through it. Next slide. So why are we doing this? Well, we're all part of Better Investing, which is fundamental long-term investing. And we want to be able to show people that have a membership in Better Investing how to be able to use the magazine and the resources there to find stock ideas. And if you're not a member of Better Investing, there's that up at the top, that 90-day trial is free, and you can be able to try it and see if it works for you. But we're doing this and really to be able to help out beginners and maybe people that are uncertain of their judgment on using the primary form that we use in Better Investing, which is a stock selection guide. We're looking to be able to do the best practices, and this is something that's been put on by the 2 Mid-Atlantic chapters, the Maryland and the DC regional chapter. And we have 3 model clubs among us, and we like to be able to promote those. And there's also a visit a club program, so that if you are in a club in Maryland, DC, or Virginia, and you want to participate, this will be a great way to be able to promote your club. And we also want to be able to promote individual members also in Maryland, DC, and Virginia. Next slide. So in just over an hour, we're going to do 4 stocks, so we'll go very, very quickly. 2 presentations will come from the BI magazine, which you have to be a member to see, but you'll see these presentations without it. One is what is called the stock to study, and the other one is the undervalued feature. Those are always up there. And then the other 2 will come from either the website or the magazine. And from that, it can also be maybe your personal experience or any of the other locations that are very popular in terms of finding stock ideas in the Better Investing community, whether it be First Cut, the online screening tools, Ticker Heat Map, Ticker Talk, weekly screens, any of the columns that are in there, and then also the BI Top 100. Next slide. So to be able to find this, and you don't have to be a member to see this, if you go to betterinvesting.org, you can go to Home About Us and the news releases, and you can see the stocks that we're going to be looking at. These 2 stocks that come from there, the stock to study and undervalued feature, Sonos and United Rentals, were announced all the way back in late May, and you can already see that they have stuff for the next 2 months up there as well. So you can take a look at that, whether in your club or as an individual investor. So take a look and use the resources of the Better Investing site. Next slide. So if you're a member and you want to be able to keep up on announcements, you can sit there and sign up under My Account up in the upper right where the red circle is. And then from there, you can come on down to the email and product subscription that I have highlighted in green. And what will pop out is that the big screen capture in the middle, that is the email and product subscription, will tell when your subscription ends, but it will also be able to sit there and make sure you click on the local news that's there. And before you hit Save Changes, go up to where the yellow highlight is, the BI Weekly Newsletter. And with the magic of hitting the next slide, this is what you will see. As this comes out as a weekly newsletter. If you signed up for it and you're not getting it, it could be in your spam filter. But this goes to just BI members, and it highlights a lot of the things that are coming up in the community across the country. One of the which is I'm highlighting there is they're going to show you what's new in the BI online tools and some of the data, which will be on the 18th of this month. They have actually back-to-back ones on the 17th and 18th. But it comes out at the close of business on Thursday, and take a look at that as a way to get some ideas. Next slide. So if you also want to reach out to us, we're on Facebook. And again, you don't have to be a member. And those are the 2 locations for where you can find latest news that's going on either in the DC regional or the Maryland chapter. Next slide. And Cheryl, tell us what's coming on in the DC regional chapter.
We're going to, in the Money Matters book discussion, which is a monthly discussion. It happens on the third Tuesday of every month. So this next one coming up is on the 16th of August from 7:30 to 9. They're going to be looking at Trillions, How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever by Robin Wigglesworth. And you can look and see. You don't have to have read the complete book, because whoever is leading the discussion will put out some great notes for you. So please tune in.
Okay, let's find out what's going on in the Maryland chapters. Let's go to our next slide. And Jonathan, you want to tell us what's going on there?
Yeah, sure enough. The Maryland chapter meets on the first and the third Thursday of the month. And if you go to our webpage, which you can see here on the Better Investing website, you can click on the local events and see what's going on with our chapter. We are closing out our stock pickers contest, which has been ongoing since January of this year. And we will be announcing the winners very shortly. The summer newsletter has been out. We should be coming out with our fall newsletter shortly. And then we will also have an announcement regarding our SSG core classes this fall too. So stay tuned. Thanks.
Thank you. Let's go to our next slide. And Kent, tell us about MMIC.
So the Maryland Model Investment Club will be meeting in 2 Saturdays, August 13th, second Saturday of the month. We are meeting online only at this point. Here's the contact information. This coming, the 13th, our education is going to be on the preferred procedure. And then our stock study right now is still up in the air. So we'll have more details later. If you would like to get more information, you can go ahead and do contact at maryland.betterinvesting.net. And that can get you to us, and we can get information to you, or you can give me an email and I'll get back with you. Thanks.
Thank you. All right. And Ken, why don't you tell us about the 2 clubs you're involved in, both this one and the next one?
Okay, so Happy Destiny Investment Club was started in 2001. We currently have 6 partners. We meet on the 3rd Friday of each month, so it'll be August 19th for August. Typically meet from 9 to 9:45. Yeah, so it's a pretty long meeting. And we've been meeting online. We will be having a planning meeting this coming weekend, and we'll be able to determine what our education and stock studies will be. If you have any questions, you can reach Kevin Glogly. Here's his email address.
Let's go to there we go. And again?
Okay, and I'm also a part of the Montgomery County Model Investment Club. We started this club in 2017. We currently have 8 partners. We meet on the 3rd Wednesday of each month, so looking at probably August 17th. And we meet for 2 hours from 7 to 9 p.m. We have been meeting online, so we're not back at the Rockville Library just yet. As far as our education, at the next meeting, we'll be discussing adding judgment, estimating earnings per share. And our stock study will be Texas Roadhouse. If you have any questions, you can reach us at mcmc@dcbetterinvesting.net.
Very good. And Gladys, tell us about McNova.
Hi there. I'm with the Model Investment Club of Northern Virginia. We started in 2008. We have 12 partners, and we meet the 2nd Tuesday of the month. Our next meeting on August the 9th is a hybrid meeting. You can meet both in person at Tyson's Pimmett Library in Falls Church, Virginia, or online at the address above. And our education is going to be looking at economic moats, and our stock study will be United Rentals. And the point of contact is below at nova@dcbetterinvesting.net.
Okay. Cheryl?
Okay, back to me. We have two actual visit a club, one for the Maryland chapter and one for the DC regional chapter. This is listings of clubs that are actively looking for members. They send in their information. So any club that is not listed here, if you will send us information, we will be glad to add you to this list. We also have a type of visit a club where clubs can request that a chapter director come and visit them either virtually or in person, depending on the situation. And we can do something to help your club members succeed and provide tools to help you with that, or any information is on the website. And so contact us at either the Maryland or the DC regional chapter, and you can request a director visit. Back to you, Kevin.
Thank you. Okay, so this is called Digging into the BI for a reason, is we want to be able to look at the Better Investing magazine and find all the benefits that comes from it. You can either look at this on an app over on the left-hand side or the electronic magazine. You don't have to wait for it to come in the mail. In fact, my latest issue looked like it got chewed along the post office. So looking at it electronically, it comes out sooner, and you can see it on your computer, your laptop, tablet, even your smartphone. So take a look at those things. And if we go to the next slide, we can see this is how, if you don't use the mobile devices, that green arrow on the left-hand side will walk you through the steps that you need to be able to get the mobile device. It's a different password than what you have for your regular one. So keep that in mind, and you can be able to set that yourself. And then the red arrow, that's going to the analyst reports and other resources. So for the featured stocks, which again are the stock to study and undervalued feature, there's additional information there. And then if you want to look at the electronic versions where the green box is in the center that says View Magazine Issues, that's where you can be able to see all the electronic versions of the paper magazine. Next slide. So we like to feature one of the articles from this month's issue. So this one where we're sort of looking at Cy Lynch has a quarterly growth stock column that comes on out, and he keeps sort of track of this. It's his own stuff to be able to see if he can outperform the Vanguard Total Stock Market Index. He generally has. He tracks somewhere between 25 and 30 stocks. Great place to find new ideas, especially for growth stocks. And he'll feature one each month. And one he's looking at here is Texas Roadhouse. So MCMC will be looking at it later on this month. But he quickly walks you through his judgment so you can see where he's going from it. And he also then tracks to see what, how often he purchases something and goes back to the well. So great way to get some ideas and use that for your own club or your own personal portfolio. Next slide. And we also like to be able to feature what's coming up with investor events, either locally or across the country. And again, this is compiled by headquarters. The green one is Philadelphia chapter has some fall webinars that you can be able to attend right from the comfort of your own home. That's the one in green. Take a look at it. And if you want to, you can, the Georgia chapter always has an August investor fair. It does cost $40, and it's going to be in person. But for anyone who's up and down the East Coast seaboard, it may not be too bad to go there. So it's a one-day event. In fact, I think I'm going to head down to it to myself with Ken. So we'll take, if you're down there, say hello. Next slide. Okay, with enough talking, let's look at some of the stocks here. The first two we're going to look at in core, it will be Sonos by Kent, and then we'll also do CarMax with Ken Williams. So let's go to the next slide. And Kent, why don't you take over?
Righty, good evening, everyone. As Kevin said, I'm Kent DeYoung, and I'm with the Alabama chapter and also a member of the Maryland Model Investment Club. So let's take a look at Sonos. Next slide, please. I was pointed to Sonos by Kevin, who asked me to analyze and present the Better Investing magazine's August stock to study. Next slide, please. So what is Sonos? When Kevin asked me to present an analysis on Sonos, I thought the company provided hearing aids to people who needed assistance due to a loss of auditory acuity. It was a little different than that. Sonos Inc. pioneered wireless home sound systems almost 20 years ago. And the company's product profile includes wireless speaker sets for home theater, automotive, and other mobile sound systems. You might have seen some of their equipment in Audis or at IKEA. More on that later. Although a medium-sized company, Sonos has grown to be a leader in wireless sound and related audio technologies. In the last 6 months, that leadership was solidified when Sonos won a patent infringement claim against Google. Google must now contribute to Sonos's revenue growth, which has been particularly strong over the last 4 years since it went public. So next slide, please. Now that we have an idea of what Sonos does, is it a good investment? As a better investing stock to study, I understand that means a company has good potential for growth. But as always, we need to do our own research. The analysis starts out well. Revenue or sales have grown at nearly 12% for the past 6 years, including 2 years prior to going public. Next slide, please. Sonos's 11.9% growth rate pushed revenue to nearly $2 billion in 2021. That makes Sonos a medium-sized company. As such, we should expect sales growth between 7% and 12%. So how does Sonos look compared to its peers? Next slide, please. So Sonos leads the industry, its peer group, and each of its 2 nearest peers in revenue growth. But what about earnings per share? Next slide, please. Okay, I thought when I started this study, a core value of BI is a company needs to have 5 years of good, positive earnings. I asked myself what possessed the BI Magazine Securities Advisory Committee to recommend Sonos as a stock to study when I saw this graph. With only 1 year of positive earnings and 5 years of negative earnings, it's hardly a model of BI growth. So I asked myself, what were they smoking? And then I asked myself, what exactly did Kevin talk me into? So I thought, what's going on with Sonos peers? Maybe there's a better choice. So next slide. Next slide, please. There we go. So again, what's going on with this peer group? It's not just Sonos, apparently. We might ask, how did a company with revenues growing at nearly 12% for at least 6 years only have positive earnings in 2021? What are the managers spending the company's money on? Yachts, Lamborghinis, Learjets? The Securities and Exchange Commission can help us find out. So I looked at the 10Ks for 2015 to 2021 and the 2022 quarterly reports, or the 10Qs, to find data that were sworn by the CEO and CFO to be true and accurate investor information. Next slide, please. Thank you. Review of the 10Ks and 10Qs gives us a lot of information that's presented here, and I don't expect you to read it, but it helps us understand Sonos's financials a little better. Our focus needs to really be on the 3 lines showing how managers spent investors' money, and there's a lot to uncover in this company. So let's zoom on in. Next slide, please. Next slide. There we go. So we're hunting for what managers spent investors' money on. Here we can see a little better. Over time, R&D spending, the stuff to grow a technology company, has been increasing. Sales and marketing, the stuff to sell products, has been increasing. And G&A, in other words, keeping the lights on, paying the rent, and paying managers' salaries, has also been increasing. Some of this may be good, some maybe not. Next slide, please. Comparing the expenses to revenue as a percentage gives us a better idea of the impact of manager strategy over the past 6 years. Again, let's focus on research and development, the amount to grow the company. Note that that amount has been at or above 12% for the last 6 years. And that's a pretty decent amount compared to Sonos's peers and Amazon, Apple, and Google. Next slide, please. Even as the pandemic wanes, the cost of revenue has been mostly stable. Although surprisingly in 2021, that cost of revenue has declined even in the face of supply shortages and all kinds of other hassles happening around the country. The R&D expense and the GA expense have remained stable. However, the sales and marketing expense declined substantially from a high of greater than 32% in 2015 to a low of 16% in 2021. And in 2022, that decline continued. So what should we take from this graph? Other companies that spend significantly on R&D continued or increased their growth in revenues. And remember, share price follows the earnings per share, and earnings per share follows those growth in revenues. So continued R&D helps companies maintain that revenue growth trend. But what about Sonos's management skills? Next slide, please. A survey of the management evaluation measures yields, measures some yields and some potential for hope. FY 2021 provided the only year with a positive profit margin in the last 5 years, though it is growing fast. ROE, return on equity, shows some promise. In the last 5 years, ROE has been increasing each year, although managers only provided a positive ROE greater than 15% this past year. However, debt can impact that. So let's take a look at Sonos's debt to equity ratio. Next slide. Thank you.
5 minutes, Kent.
Thank you. Sonos's managers have done a great job supervising their debt, and I'm impressed that in 5 years, Sonos's debt has gone from a high debt company at nearly 100% debt to equity to a very low debt company of less than 7% or almost 7%. The debt reduction is a significant improvement for this company, and so Sonos might be poised for growth. But the question is, how much growth? Next slide. Next slide. Thank you. The revenue growth was very consistent. I mean, the revenue curve was nearly a straight line. I didn't really want to deviate from the 11.9% growth rate too much. However, estimates from the industry analysts range from 8.2% to 14.2%. And the projected revenues for the next 2 years were very tight. So this is a consistency range that was kind of challenging to deal with. After doing some statistical analysis, I decided on a revenue growth rate of 9.4%. Next slide, please. While Sonos's revenue growth rate was consistent, the EPS, or earnings per share, was anything but. Other analysts had a large range of growth ranging from less than 1% to nearly 30%. After some statistical analysis on the industry estimates, I was unconvinced of an earnings growth rate of 12.8%. So I decided to use the revenue-based earnings estimate, aka the preferred procedure, developed by BI's George Nicholson. Next slide, please. So I like the preferred procedure because it allows me to make a more refined estimate of the earnings. And the spreadsheet is a very nice way of updating calculations and attaching rationale to the selected values. I'm really happy with the 9.4% earnings per share growth rate. Next slide, please. Next slide, please. So we need an estimate for the high PE and low PE to forecast a high and low price. Traditionally, we use historical values to make those estimates. The values for Sonos were more hysterical than historical. Next slide, please. I opted for an eyeball estimate based on the most recent and not so wacko PE ratio shown by Big Charts from the 15th of May of last year to this past Friday. And this is the actual COM part of the chart. I'm sure that with your really good eyes, you can see that the chart is showing a high PE around 45 and a low PE around 18. Next slide, please. So I chose 30 for a high PE and 15 for a low PE. From the SSG calculations, I project a high price of $45.60 per share and a low price of $14.50 per share. Next slide, please. As of Friday evening, Sonos' stock price was $22.11 per share. This price falls just inside the upper end of my projected buy zone. Today's close was $21.83. Given the analysis, I would consider this a good price for buying Sonos. Next slide, please. The projected compound annual return could provide a doubling in value of an investment in Sonos in the next 5 years. And depending on the portfolio, Sonos could be a great addition to a growth portfolio. However, it provides no dividend, so a portfolio seeking income would want to look elsewhere to invest. Next slide, please. And in case you want more information, here's some hyperlinks for you to go search on. You can learn more about Sonos's collaboration with IKEA and Audi, and you might also be interested in some company infrastructure challenges facing Sonos. A good reason to be conservative on our estimates. Next slide, please. In conclusion, Sonos was a stretch company for analysis. I learned a lot in this analysis, and I really thank Kevin and the DC chapter and the Maryland chapter for the opportunity to take on this analysis. I think Sonos may be a breakout company after the managers clean up the infrastructure and technology challenge they're facing. And maybe they might also add some sound to their corporate website videos. Who knows? For now, Sonos is a worthy candidate for purchase, and as of Friday, it was on sale. After today, it's even more on sale. The share price seemed to be going up and down and vibrating, though, toward a higher price. The fundamentals of the companies look reasonable and may be better after their earnings release on the 10th of August. So next slide, and Mr. Williams, I think we're on to you.
Thank you, Kent. And go ahead, Ken.
Okay, so I am with the DC Regional Chapter, part of two investment clubs, MCMC and HDIC, lifetime member of Better Investing. So I'll be discussing CarMax today. The company is headquartered in Richmond, Virginia. It's the largest automotive retailer in the United States. The company was founded in 1993. While CarMax is the largest used auto retailer in the U.S., it represents about 2% of the total used car units sold in that market. As of February 28th, 2022, the company had 32,647 full and part-time associates, including 26,213 hourly and salary associates. No workers are currently under collective bargaining agreements. Next slide. You can find KMX as part of a screen using BI online tools. The parameters for the screen are 9-year sales growth greater than 8%, 5-year R squared EPS greater than 50%, and PEG ratio less than 1.5. This screen will result in approximately 41 companies to research on their own. Next slide. As of February 2022, CarMax operated 230 used car superstores in 41 states. Their physical footprint and logistics provide speed and cost advantages over their competitors. Next slide. The company thinks that it was the first to offer a large and varied selection of higher quality used cars at competitively low, no haggle pricing and a customer-friendly sales process. CarMax both purchases vehicles from customers, offering free appraisals, which are good for 7 days, regardless of whether the owner purchases a vehicle from the company, and sells vehicles and offers free appraisals via its free appraisal process, and also sells vehicles. Next slide. The company plans to achieve 2 million retail and wholesale units and 33 billion in revenue by 2026. And they are also seeking or expect to expand their market share to exceed 5% by 2025. While CarMax is the largest used auto retailer in the U.S., it still represents about 2% of the market. Next slide. The company's strategy is to overcome important sources of customer dissatisfaction with the traditional auto retailers while maximizing operating efficiencies. The company ultimately offers several options to serve the customers how they want to be served. Next slide. CarMax expects long-term growth to come from new products and services, bridging gaps and adjacencies to its existing offerings. For example, unlike many other auto auctions, CarMax owns in all the vehicles in its auctions, which allows the company to maintain high auction sales rates. The company also provides financial services to customers through CarMax Auto Finance. Next slide. CarMax has made the Fortune magazine's list of best places to work. During the pandemic, every manager met with their associates to help balance work and family life. Next slide. And taking a look at the value line here, as of July 22nd, its price is trending below the cash flow line, suggesting that it is undervalued. The value line 5-year total return range is between 16 and 28%. There is opportunity for modest PE expansion and net margin expansion over the long term. CarMax is also buying back shares. Next slide. CFRA shows CarMax as a 4-star buy with a potential 12-month price appreciation to $115 per share. Most locations average a 47-day supply of used vehicles to sell versus a 14-day supply on new car lots. CarMax has $95 million in cash currently. Next slide. CarMax shows as a 4-star buy with a fair value estimate of $155 per share with a positive moat trend. The company also has a low environmental, social, and governance risk score, or low exposure to the risks related to environmental, social, and governance. Next slide. Looking at the bull and bear case, a view of the bull case suggests that CarMax is poised to gain market share in any environment. It's poised to be the online leader in used vehicle retailing, and no competitors have successfully duplicated its retail model. A review of the bear case suggests that CarMax is not immune to a recession, and large franchise auto dealers are trying to replicate CarMax's success with their own versions of standalone used vehicle stores. Next slide. For those of you who are subscribers to Manifest Investing, CarMax ranks highest in quality for the auto and truck dealerships industry, and ranks 3rd for par in that sub-industry. CarMax meets the requirements to be considered a core holding. If you simply add the ratings for quality, financial strength, and EPS score, scores above 225 meet the requirements to be considered a core holding. Next slide. All right, so pre-tax profit on sales and percent debt to capital are slightly below their 5-year averages. And return on equity is slightly above its 5-year average. Next slide.
5 minutes, Ken.
Okay. My adjustments for 5-year sales and earnings are 7.2% and 9.2% respectively. Both are below their 10-year averages. I wanted to make some adjustments for the high inflation environment that we are currently in. Next slide. My judgments for high and low PE are 21.8 and 11.9 respectively. They're both based on their 5-year averages. My low price is $70.10. Next slide. CarMax is in the buy range based on my SSG from this past Friday. Next slide. The 5-year compound average return is 14.9%. Next slide. So CarMax is a leader in a highly fragmented market. Their scale, technology, and talent drive their competitive advantages. They have the most customer-centric offering in the market today. Investments, acquisitions, and strategic partnerships will drive growth and the widening of their economic moat. And their operating and financial model drives shareholder value. Next slide. So in conclusion, CarMax is a large-sized company with positive moat characteristics. I believe it's well managed. It is trading in line with its 5-year average PE. It's a buy below 102.40. I believe it closed around the 101 area today. And then I believe that CarMax is worthy of your consideration.
Thank you, Ken. All right, so we did our first 2 in core. Now let's look at SSG Plus, and let's talk about United Rentals. And Gladys Henriksen, go ahead and tell us all about United Rentals.
Hi, everyone. I'm with the DC Regional Chapter at McNova, and my stock, United Rentals Incorporated on the New York Stock Exchange, URI, was featured in the August issue of Better Investing Magazine. Next slide. Here it is, page 24. And what's the deal here? They chose this because of the passage of the $1.2 trillion Infrastructure Investment and Jobs Act. And that is going to provide funding in an area that has been underinvested for the last 3 years for highways, transit, hazard material research, broadband expansion, clean water, and electric grid improvements, all prime customers for United Rentals. Next slide. United Rentals is in the industrial sector. It's in the rental and leasing services. It's a medium-sized company with sales $9.7 billion in 2021, so it's almost large. It was founded 25 years ago. Its customers are largely commercial construction and industrial, a little teeny bit of residential. It has 2 sectors, general and specialty rental outlets. We'll talk more about these as we go along. But there are 1,300 outlets, 85% in the US, and it covers all 10 Canadian provinces and 49 US states, not Hawaii. It has 15% market share in a very fragmented market. So if you look at the pie chart on the right, you see that United Rentals exceeds that of Sunbelt, which is an ADR owned by a British firm, and HRI, a California-based company, which is about as old as United Rentals, and it started out providing equipment for film production companies. And then the rest are 71%. It looks like a huge field ahead, a huge runway, but it is fragmented. You have all kinds of individual rental agencies, including large groups that do some rentals like Lowe's and Home Depot. Next slide. BI Magazine's rationale for choosing it is because URI is the world's largest provider of rental construction, because of the Infrastructure and Jobs Act, and because renting equipment has proven preferable to owning equipment with geopolitical uncertainties, inflation, and higher borrowing costs. Furthermore, demand among oil and gas customers has become really solid, and management predicts growth through 2023. However, this is a highly cyclical industry and share prices are volatile. Next slide. This shows these graphs show customer preferences for leasing versus buying. The large graph on the left simply shows that over the last 25 years, leasing has grown. The compound annual growth rate has been about 5%. The graph on the top shows the growth of rental versus ownership of equipment. And on the bottom, it shows the increase in revenues from the 10 largest leasing companies. Unfortunately, cut off 2021, but it's gone up to 40%. So essentially, that's another 5% growth per year. Next slide. So what is its strategy? On the revenue side, URI intends to capitalize on this shift toward rental over ownership. It focuses on cross-selling its customers to capture more wallet share. It's evolving strategies and its asset base, i.e. equipment, to better serve diverse customers and capture new opportunities. And it differentiates its service through new technologies and accelerated innovation. And finally, it's been growing a lot through mergers and acquisitions, and it's planning several acquisitions of smaller companies that it can bolt onto its company this coming year. And then on the cost and margin related area, it is leveraging its lean concept. The lean is its tool, or it's a methodology for problem solving and workflow configuration. For example, before it starts any project with a customer, it does a workflow analysis to determine what is the least amount of equipment they can lease that would keep it occupied almost continuously, rather than spending a lot of money for idle equipment. And that creates continual improvement of labor productivity, and customers very much like that. So they are trying to leverage their costs by utilizing equipment more often, and then also M&A growth. And they're mixing the shift of equipment as their specialty sector outpaces the total growth, including general. I'll show that to you soon. And that brings with it a customer mix. And then they're further leveraging technology and systems. For example, they now have a GPS mobile app that traces the equipment for its location, both for itself and for customers, and wherever they leave it, and it tells you what its usage it has been. Then they have another kind of tool, electronic tool, which is acoustics and mapping tool to locate pipes underground. So you can see that they're investing in a number of these technologies. Next slide. This shows their two sectors, general revenues and services, which they've had for 25 years. And within that sector, most of it is leasing, but they also sell both new and used equipment, and they offer contractor supplies, and they do such services and repairs. And then their four-year new sector, specialty rentals and services. And that just started with some acquisitions, which I'll tell you about in the next slide. Next slide. This shows you an example of the equipment that falls under the general rentals category. And it ranges from the aerial work platforms you've seen around to power and hand tools and forklifts and many things that are quite competitive, I would say, with Home Depot, etc. Next slide. Next slide. Thank you.
5 minutes, Gladys. 5 minutes.
Rentals began with its acquisition of Baker Core, in July of 2018. And here they have trench safety, which has excavation support for construction utility installs, power and HAV. They transport fluids now for industrial plants and mining. They offer trailers of tools, which they drive to a site for special projects. They have on-site services like the porta-johns. And then new for them are portable storage and modular spaces. They can construct these little offices at construction sites. Next slide. Their competitive advantages you can glean are the size, breadth, and diversity of its fleet, the benefits of scale and diversification, investments in technology. And it's the customer service focus is on being a one-stop shop, ensuring safety, reliability, and making the rental fleet productive, and is now investing in a greener fleet. It's ordered Ford's new battery electric light pickup trucks and vans, and they're trying to replace diesel fuel with lithium batteries in some of the generators that they lease. Next slide. Next slide. They're trying to manage their leverage. They've all of the companies in this area have high debt ratios, and they're trying to keep the debt to equity ratio below 2. Above 2, analysts find it becomes a kind of shaky company. At the end of 2021, their debt ratio was 1.5 to 1, and increased their liquidity. And they have a B+ rating or a B++ from many analysts. And they're investing in their growth, as we talked about before, both with current customers and by mergers and acquisitions. And they do return cash to investors, although they do not offer a dividend. They have been buying back shares. Next slide. They're working on margin improvements. In 2021, the margin of was 19%, and the key drivers are those second two bullets: improved efficiency gains using that process improvement of lean we talked about, and technology. And they have a new improved mix of products they lease, focusing on the higher margin specialty tools. And they're going to de-emphasize their low margin business. Next slide. It's a little bit redundant. Their focus is on improving their financial goals to debt reduction and fleet productivity, which measures the effective changes in rental rates, utilization time, and customer product mix. Next slide. They just had their second quarter 2022 earnings conference call last week, and I listened in, and the last two bullets were very helpful. For example, the president reported they had a blowout quarter again, and it projects a 15% growth by the end of 2022, and with strong backlog through 2023. Next slide. So here in the SSG, you can see the first quarter sales and earnings per share were up 22% and 80% respectively, but analyst consensus estimates are about 10.7%. I chose sales and earnings to be 9%, and I'll show you why as we go on. Next slide. The management has been very good. The pre-tax profit on sales was 19%. We talked about margin earlier for 2021. Return on equity is a healthy 25%. We look for something above 15%. Then in section 3, the PE history, you will see the average PE ratio is 11.6, but right now it's a little over 13. So it's a little overpriced. Next slide.
2 minutes, Gladys.
Okay. Here are some analyst reviews of United Rentals. Value Line projects its growth about 15% over the next 5 years. And although they call it timeliness now is 3, but they still give it a B+, and they think its high price in the next 5 years will be $670. It says United Rentals should punch above its weight when it comes to securing infrastructure related business. Next slide. CFRA gives it a buy rating of 4 stars, and it says it projects that revenues will increase 15% in 2022, 7.5% in 2023 for an average of 11%. Next slide. Morningstar above says that it gives it a 4-star rating, and it compares it to the peers we talked about earlier. So most of and gave them lower ratings, but it expects sales to grow 5%, which is a little disappointing. But if you note at the bottom, the analysts' average consensus around 10%. However, yesterday or on Friday, Zacks upgraded its rating to buy with a 15% growth in the next 5 years. However, Yahoo forecasted 6.5% revenue growth by year 2023. So analyst forecasts are all over the map. Next slide. So I chose the 5-year average for high and low prices of a PE of 15.8 with a high earnings per share forecast at 9%. And that gave me a high stock forecast of $615, which is below Value Line's high projected of 670. And my low, I took 20% below the current price, which is also under the 52-week low, as you see at the bottom. And when I took it was 20% below 277 when I did this study last week. Anyway, next slide. So in this range, it's in the buy side with a 5.8 to 1 ratio, and with a total return of high PE of 17% and a projected return average of 10%. And the buy price to satisfy this is $306. Now, today the closing price was about $320, but it's a volatile stock, as I mentioned, and you have to watch it. Next slide. In conclusion, it's a medium-sized growth company. It's well managed. I think it's a buy up to $306. It's fairly priced, trading near its historic average PE, and it could be a short to medium range infrastructure play candidate for purchase. Thank you.
Thank you, Gladys. Great job. And last but certainly not least, Jonathan, why don't you tell us about Monolithic Power Systems?
Okay, will do. Thank you. Let's go to the next slide. So Monolithic, I found this under the one of the predefined screens, roster of quality companies. And you can also find it if you did a search under the First Cut site on the BI website, you would also find some First Cut studies on it. Next slide. So Monolithic Power Systems is in the semiconductor industry. It is a medium-sized company. It's actually just transitioned to become a medium-sized company, and we'll talk about that. It provides power circuits for communication, storage, and computing, consumer, automotive, and industry applications. Next slide. So when you do your research on this company, you're going to come up with this terminology, fabless. And so what this is there are different semiconductor business models. And on the left-hand side, you can see many of these different models. Monolithic is considered a fabless company. What it does, it designs its product, it sends those designs to a foundry, and you can see that a couple of rows down. The foundry or the fabricator or the manufacturer will manufacture the product, test it, and package it, and then send it back to the fabless company, for example, Monolithic, for sales and distribution. And one of the several advantages of this are the companies such as Monolithic can focus on designing their semiconductors at a lower expense. It doesn't have to shell out large quantities of investments for factories for manufacturing. Therefore, it can also earn high returns too. Next slide. The global power management integrated circuit market is growing, and analysts are anticipating a 16% compound annual growth rate with expected valuations of $128 billion by 2031. So there's huge growth opportunities here for Monolithic. Next slide. Unfortunately, Monolithic is a small player in the power management. They only occupy about 2% share. However, their revenue growth far above the largest competitors. And if you look at the spreadsheet to the right, you can see that Monolithic has been growing sales at almost 22%. And when you compare it with the peer group and industry average, and also Texas Instruments, which is a large size company, Monolithic is actually doing quite well. Unfortunately, I say unfortunately because if large companies like Texas Instruments or even Analog Device decide that they want to compete with Monolithic with respect to their process technology, this could really dampen the firm's growth in the future. Next slide. Morningstar has labeled Monolithic a disruptor. I like that word because when I hear disruptor, that means they're innovative, they're creative, they're shaking up the status quo, so to speak. And they're disrupted because of their proprietary advanced manufacturing process. And what this does is that it allows them to integrate many functions on a single chip. If you look at the diagram to the right, imagine that small chip with all these internal components, but the size is only about 4 or 5 millimeters. So this is a huge advantage for Monolithic. Next slide. Morningstar has also awarded Monolithic a wide economic moat, and this is fantastic. There's less than 25% of the companies in the Morningstar universe has this wide economic moat designation. Part of the reason, or primarily, is due to their chip design and the high switching costs for other companies that they contract with. What this also enables Monolithic is that what it says is that Monolithic will be able to sustain this competitive advantage for at least the next 20 years. Next slide. So Monolithic has over 4,000 products. They're in computer systems, 5G, robotics, medical equipment such as ultrasound and x-rays, RVs and boats, and all the way to the left, home appliances or the Internet of Things. Next slide. They have products in data communications and security, such as Wi-Fi. Next slide. They've incorporated products within clean energy and storage, such as solar, battery storage, wind farm. Next slide. Their products are also in CPUs, GPUs, storage systems, and data centers. Next slide. One of their most rapid growing areas is in the automotive end market, and they've actually won many designs for advanced driver assist systems. That's the ADAS that you see on the left-hand side, and that would include like the cameras and driver monitoring systems within vehicles. And you can see that they're incorporating products in just about every aspect of vehicles. Next slide. So looking at the sales and earnings growth, they look fantastic. They're growing about the same rate, and they're also growing very consistently. You can see in 2021, the sales had topped off at $1,208 million. The dotted green and the dotted blue lines represent my sales and earnings forecast of 20%, and I'll talk about that. And you can see that they're below the analyst estimates, which are representative by the light green and the light blue circles. Next slide. The company's financial strength is A+, fantastic. The light blue line is shares outstanding. So they're actually introducing more shares. And typically when companies do that, they're generating capital for acquisitions or research and development. But if you look at the purple line, they have significant cash flow. They have a lot of free cash. They have about $250 million in free cash. The black line represents book value per share, which means that if you own this company, the value of your shares would be perceived to increase. The green line is the dividend, and that's been growing, and they pretty much have no debt at this point. You see, there was a little bit of debt, and it's practically down to zero again. Next slide. I like to look at the quarterly growth trend graphs, and the last 4 or 5 dots represent about the last year. So you can see that they have been peaking. You'll notice that each one of those graphs actually has a black line, which represents zero growth. On the sales and profit margins, it's really indicated as a faint gray. But when you look at the last 4 or 5 dots or so, you see that they almost seem to be peaking. This is a cyclical industry, a cyclical company. So I take that into consideration when I'm considering purchasing this company, whether or not the profit margins, the pre-tax profit and earnings and sales are going to be decreasing within the next few quarters. Next slide. The sales growth trend and the earnings growth trend, if you look at the graph, they have had a significant increase over the last 2 years, and that's related to the pandemic. And you can see over the last 5 years for sales and earnings, they were 23.9 and 31.2%. And the most recent quarters have been excellent with sales of 48.4% and earnings of 73.7%. Next slide.
5 minutes, Jonathan, 5 minutes.
Okay, thank you. Management, this is management's scorecard. Now, when you compare Monolithic with the peer group average, they have done, management has done an excellent job. They have exceeded the peer group average in all of the growth metrics. When you compare them with direct competitors, with the exception of Texas Instruments, and remember Texas Instruments and actually ST Microelectronics are both large companies. Analog Devices is a medium-sized company. But Monolithic is doing either equivalent or a little bit better than the direct competitors, again, with the exception of Texas Instruments. So I think management has been doing an excellent job. Next slide. So I tabulate a lot of the analysts' forecasts for sales and earnings growth and future price. And when I do it this way, it really allows me to look at the trends. So what I'm noticing is that the analysts are anticipating sales and earnings to slow over the next 5 years. So I take that into consideration when I selected my forecast of 20% for both sales and earnings growth. And when you look to the right, you can see the 5-year estimate of $2,630,000,000 for sales and $11.35 for earnings. And they're below the average sales and earnings dollar figures that you see in my table above. Next slide. And so looking at the current PE ratio of 80.7, that is above the average PE of 61.7, which means if I was to have purchased this company at $464.72 as of last Friday, this company would be overvalued. I would be paying too much for it. I love this big charts, PE ratio chart. And what this is showing me is that the PEs have been really very consistent over the last 10 years. And I just put the red lines to indicate the high and low PEs. Now, with the exception of 2020 and 2021, which I considered outliers, again, the PEs are really very consistent. So I excluded those outliers in the table above, and I used the 75.4 high PE to calculate my high price, which we'll see on the next slide. So I'm getting a high price of $862.60. And my spreadsheet above is indicating the analyst's forecast for price ranging between $450 and $840 with an average of $665. So I'm a little on the high side. The 3 to 5 year projections is from Value Line. And if you look to the under the appreciation potential, that's with the second star. Value Line is saying that this company could reach a price appreciation of about 80%, which is similar to my potential price appreciation in the buy zone box of 85.6%. So this is another checks and balances that I like to use. And then the annual total return projection, Value Line is suggesting returns between 5% and 16%. And when we go to the next slide, You see, I'm getting returns between 9.6% and 13.9%. So Monolithic Power Systems, I think, is a very high quality company. They have over 4,000 products. They are rapidly growing in the automotive segment. They have no debt, steady positive free cash flow, steady increase in dividends, and they're investing, because they're a fabless company, they're investing heavily in their research and development. The last line is actually from the website, and some other analysts have also talked about this, that they grow revenue regardless of the market environment. So they will grow revenues even during these cyclical corrections. Next slide. So Monolithic is a medium-sized, fast-growing company. It's very well managed. Unfortunately, I think it's overvalued right now, but I think it's worthy candidate to add to your watch list. Thank you.
Thank you. Well, folks, we went through that very, very quickly. We did 4 stocks in under an hour, I think about 50 minutes. So we're going to go through a sort of a quick recap. So there again, it's Sonos, United Rentals, Monolithic Power Systems, and CarMax. And let's go to the next slide. And we like to talk about where it fits in the life cycle, which comes from T. Rowe Price. So you can be able to take a look at this. Let's go to the next slide and let's have our panelists sort of tell us why they think they picked out this stuff. This comes from the digital handbook, and a lot of people look at it. Kent, why don't you tell us why you have Sonos over there right at the beginning of the explosive growth and almost close to speculation?
Yeah, the reason I've got it over there is with 1 year of data and going from negative to super high with a 200% growth rate of the earnings, that's pretty explosive growth in my mind. And I would say speculation because right now it is a pure guess as to whether the management team can continue to pull off high growth with the company. Current fiscal year is starting already to show perhaps maybe not. So we'll see.
Okay, Ken, tell us why you picked that location for CarMax.
Okay, so CarMax, as I said, has moat-like characteristics. I certainly believe they're entering into the major growth area. So it's kind of why I selected that spot.
Thank you. And Gladys, tell us why you picked that location for United Rentals.
Well, right now the infrastructure projects are really big. I think they're moving into especially rentals, and that means the mining and manufacturing and investment in infrastructure, both here and I think overseas. And with projections of double-digit growth over the next 2 years, I'm not quite sure in this cyclical environment whether that's where it belongs. I don't think it's quite mature growth yet with that kind of growth ahead of it. And so it depends on how they acquire more companies and the continued investment in these areas.
And Jonathan, tell us about Monolithic Power and why you selected that location.
I think Monolithic has a really long runway for growth opportunities. They, with this proprietary manufacturing process and Morningstar's wide moat designation and this competitive advantage for the next 20 years is extremely helpful. The global power management market is anticipated to continue growing at about 16%. And then the automotive segment is a really fast grower segment for Monolithic. So again, I think they've got a lot of opportunities ahead of them, and they're growing quite rapidly. Their sales have just been through the roof. They've just been growing fantastic.
Okay. Well, after all this talking, let's go to our next slide. And it's now time for you all to vote. So Cheryl, if you can release the poll. And all of you get a chance to vote just once. But I'm glad to see we got everyone voting. It's moving along pretty good. Let's see, we're up to the 60% range. Let's see if we can get up a little bit higher. Yeah, we have. Can we get up into the 70s, maybe even 75 or 80? Seems like we're sort of holding off right about there. 3, 2, 1. Okay, go ahead and close it out, Cheryl. And there it is. By a runaway, it's Monolithic Power. So there we go.
Good choice, everybody. I agree.
I know you would. Anyway, so we went through this very, very fast. Please make sure to download the handouts and the completed SSGs to be able to look over it. And we will have this up on YouTube, maybe even later on tonight. Let's go to our next slide. And so if we do have any questions about digging into the BI, there's a Gmail account for this, or you can reach out to either people from the Maryland or DC chapter. There's a picture of a group of us that were down at Bink in Dallas just last month. But please stay connected with all of us here in Maryland, DC, and Virginia. Next slide. Go ahead and join our mailing list. You don't have to be in the DC chapter, so you will get the notices for that. Our very talented Carol will be sending out the messages. She's on here, so we're grateful for all the coordination that goes on with that. And let's go to, I think we have a few more slides here. Kent, tell us all about volunteering.
Okay, we can talk about volunteering. So if you're interested, if you found this particular event useful, let other folks know. And volunteering, we have 2 chapters out there, all of, as you were told earlier, everything that was done this evening was done by volunteers. All of the work that went into the presentations, the logistics, all of that's managed by volunteers. So if you're interested in helping, we'd appreciate that. And if you do help, then you get some really good benefits, which are listed there. So next.
We went one too fast, so back up. And Jonathan, tell us what's coming up.
Okay, so next month, September, we will be back here on the second Monday, September 12th. We will be looking at Align Technology and Qualcomm. Those are the stock to study and the undervalued feature, respectively. And then we'll also be looking at Tractor Supply Company. And if you've never heard of Rio Tinto, tune in. The next slide. And then you can visit us on YouTube. That is an active link. So if you click on that link, it will take you directly to our website where we're actually storing and saving all of these webinars for your viewing pleasure at a later date too. So definitely take a look at the website. Please subscribe and take a view many of the webinars that you either have missed or you want further clarification of some of the analysis that we have gone through. Thanks.
And we haven't done it yet, but do we see any questions or do people want to raise their hand? We've been doing a lot of yakking.
We have some questions. We have questions. So the first question out there is from Lola, and she's asking, Jonathan, are you concerned about supply chain issues that other semiconductors companies have experienced? And Robert also asked a similar question about the available, actually, completely different question, but go ahead and answer Lola's first, and then we'll throw another question out there.
No, I don't have. That's a temporary issue, and it's slowly resolving. Much of the information that I had read from the analysts, they didn't really touch on a lot of the supply chain issues that was prevalent over the last 2 years. So I suspect that things are really starting to slow down, and they're starting to rejuvenate their supply chains again, but that didn't really seem to be much of an issue at this point, and even looking in the future.
And do you have any thoughts on how the chip manufacturers are dependent on the federal government for building new foundries, apparently with the new CHIPS Act? How that might impact Empower?
Because I don't have any comment regarding other companies, specifically Monolithic, because it's a fabless company. I don't think that's a concern from them at this point. But if there's other companies that are like the foundry companies that I talked about, and I think one of the biggest foundries is Taiwan Semiconductor, but that's obviously a Taiwanese company, but I don't know if they're building any companies in the United States. But they would benefit from that CHIP Act. But Monolithic itself, probably not, because I think part of their business model is to continue to remain as a fabless company. So I don't think they're interested in growing, developing factories in the United States to manufacture their own chip. At least for now, anyway. That might, again, I have not. They just came out with that CHIP Act just recently, so I can't really comment on how that's going to affect Monolithic in the future. I have not heard of anything at this point or read of anything at this point.
Okay, well, that's all the questions that we have, and we have no raised hands.
Anyone want to ask a question in the audience? Raise your hand. We can unmute you. Anyone? I guess
Going
not.
once, going twice.
I just want to say to our audience that if you enjoyed these webinars, please let people who are also like-minded investors know so that they can tune in as well.
And again, you don't have to be a member of Better Investing to participate. We think it's a great organization. Again, we're all volunteers, but it's a great way to be around like-minded long-term fundamental investors. With that, thank you very much for being here. And if there, we do have a hand raise, so let's do this. All right, David, you've been unmuted, so you're muted on your side. So go ahead and click on your microphone and you can ask your question. Wait, try it now. You're now self-muted, so hopefully you can, there you go.
Yes. Good evening. It's more of a comment. I just read an article related to the CHIP Act that the Taiwanese company is planning to build a manufacturing plant in the United States.
Okay.
Who Monolithic is?
No, not Monolithic. The Taiwan manufacturing company in Taiwan.
Okay,
They're the principal largest chip manufacturer in the world.
Yes, absolutely. So
they're planning to build a plant here in the United States.
Okay, all right. Thank you. Appreciate that.
Any other questions? All right. If there are no more, we will see you next month, and we're going to wait a week because of Labor Day. So we'll do it the week after Labor Day. Please come back, share this, and we'll see you then. Good night, all.
Good night, everyone.